Most Americans think their 401k is the golden ticket to retirement. But here's the thing. Millions are walking straight into a tax trap they don't even know exists. And once you retire, it's too late to fix it. Let's start with the big mistake. People think the money in their 401k is all theirs. It's not. A huge chunk of it belongs to the IRS, and the amount they take depends entirely on what happens to tax rates in the future. When you contribute to a traditional 401k, you're deferring taxes, not avoiding them. You're basically saying, "I'll pay later." The problem is, later might mean paying a lot more. The 2017 Tax Cuts and Jobs Act temporarily lowered income tax rates, but that law expires at the end of 2025. After that, the old higher brackets return unless Congress steps in. That means millions of retirees could see their withdrawals taxed at higher rates than they ever planned for. Let's make this real. Suppose you retire in 2030 with $1 million in your 401k. Sounds solid, right? But when you start taking money out, that's all taxable income. At today's rates, you might lose around 20 to 25% to federal tax. But if rates jump even a few percent after 2026, you could lose closer to $300,000 over your retirement. That's not market loss. That's tax loss. And here's the second part of the trap. Required minimum distributions, or RMDs. Once you hit age 73, the IRS forces you to start taking money out of your 401k, whether you need it or not. Those withdrawals count as income and can push you into a higher tax bracket. They can even make more of your Social Security taxable and increase your Medicare premiums. So even if you're living modestly, the system quietly squeezes more tax out of you every year. Now, most people don't realize this until their first RMD notice shows up. But the smart ones start planning years before retirement. So here's how you avoid being one of the millions who regret it. Step 1. Diversify your tax buckets. Don't rely only on pre-tax savings. Start building up Roth accounts, Roth 401ks, or Roth IRAs, where you pay taxes now, but withdrawals are tax-free for life. With tax rates expected to rise, paying a smaller bill today can save you a massive one later. Step 2. Take advantage of Roth conversions before 2026. You can move money from a traditional 401k or IRA into a Roth, pay tax at today's lower rate, and let it grow tax-free. Step 3. Keep your withdrawals strategic. You don't have to drain your 401k all at once. Mix income sources like TFSAs if you're Canadian, or Roth accounts and brokerage investments in the US, so you control your taxable income year to year. The bottom line. The biggest mistake isn't saving too little. It's not understanding how your money gets taxed when you finally need it. You worked hard for decades. Don't let the IRS decide how much of your retirement you actually get to keep. If this opened your eyes, hit subscribe, because the truth is, the rules are changing fast, and knowing them before everyone else can literally save your retirement.